The most dangerous investor I have ever encountered is not the reckless gambler. It is not the person who put everything into a single speculative bet and watched it collapse. The most dangerous investor I've seen in 84 years of watching markets is the disciplined one. The person who follows a financial system faithfully, feels confident because of the structure it provides, and never questions what the system quietly leaves out, because that investor never sees the loss coming. By the time it arrives, the formula has convinced them they did everything right. A rule is circulating right now that describes itself as the way the top 1% manage money. It goes like this. Put 25% of your income into growth assets, 15% into a stability fund, 50% toward your essential expenses, and 10% into guilt-free personal spending. The rule says that 75% of wealthy people built their wealth as entrepreneurs, 15% as investors, 7% inherited it, 0% from salaries alone. The conclusion, own something, or you are the thing that is owned. I don't disagree with the philosophy. I spent my life buying ownership stakes in businesses I understood deeply. But I want to tell you what the formula leaves out, because that omission is why thousands of people following this rule faithfully are not building wealth. They are funding speculation with the discipline of a system, and they don't know it yet. Meet James. He is 38 years old, software developer in Austin, Texas. Good income. For 18 months, he has followed the 25, 15, 50, 10 rule with genuine commitment. Every month without exception. His 15% stability fund sits in a high-yield savings account, earning 4.5%. His 50% essentials are tight and clean. His 10% reward budget is guilt-free, as the rule instructs. James feels like he's managing money the way the 1% manage it. He owns something. He trusts the system. What the system never told James is how to evaluate what he was buying, and that single gap has put 40% of his growth allocation into instruments that are doing the exact opposite of what the rule promised. If this is the kind of conversation you need to hear before you allocate your next dollar, subscribe now and turn on the bell. What we do here is not about formulas that feel right. It is about understanding that actually works. I'll show you what James bought, and more importantly, why, right after this. The rule presents a hierarchy of growth assets. At the lower risk end, index funds and real estate. In the middle, high income skills and online businesses. At the higher risk end, individual stocks. And at the top of the scale, the high risk, high reward alternative tier, Bitcoin, Ethereum, NFTs, gold, collectibles. The framework presents crypto and NFTs not as speculation, but as a risk category within a legitimate wealth-building continuum, just sized appropriately, never more than you can afford to lose. Here is what that framing does to someone like James. James is disciplined. He does not put everything into Bitcoin. He puts 40% of his growth bucket into crypto because the rule said alternatives belong on the scale, and 40% felt moderate within that framing. He put 30% into a drop-shipping business because the rule said online businesses are high risk, high reward, and he felt ready. 20% into individual technology stocks, and 10%, only 10, into an S&P 500 index fund. James is not gambling. James is following the system. That is precisely the problem. 18 months later, his growth allocation is down 40% from its peak. The dropshipping business generated less than $2,000 in revenue against $4,000 in costs. Crypto dropped 60% before partially recovering. The individual stock swung with quarterly earnings reports James did not fully understand. The 10% in the S&P 500 performed exactly as history said it would. James doesn't blame himself. He followed the rule. And this is how the quiet destruction works. The percentages always look right. The system always feels organized. But the formula told him how much to invest. It never asked whether he understood what he was buying. My first rule of investing has never changed in 84 years. Never lose money. My second rule, never forget the first. Every position I have ever taken began with one question. Does this investment have a genuine probability of permanently destroying my capital? Temporary declines in great businesses are opportunities. Permanent destruction is simply loss. The rule James followed never asked that question. It asked how much to allocate, not whether the allocation made sense. This is compounded by a sequencing error in the framework itself. The formula puts growth first, 25%, the largest bucket, the first priority. Stability second at 15%. But stability must precede growth in every honest approach to building wealth. You cannot invest intelligently when you are financially fragile. When your growth allocation is at risk and you have no buffer beneath you, you make decisions from fear, not analysis. You sell at the wrong time. You hold things you don't understand because you cannot afford to realize the loss. Rule number 1 is not about percentages. It is about sequence. Protect first. Understand what you're buying, then invest the capital you can genuinely let compound for a decade without touching it. And this brings me to the deepest flaw. The formula says, own something because if you own nothing, you are the thing that is owned. This is a genuine truth. Entrepreneurs own companies. Investors own assets. The 75% who built wealth as business owners did so through compounding ownership of something with real earning power. But owning a fraction of a cryptocurrency you cannot value, in a network whose long-term utility you cannot describe, whose competitive position shifts with each regulatory announcement, that is not ownership in the sense that created the 75%. It is holding a position in something you hope will be worth more tomorrow than today. That is speculation. Speculation and ownership look identical in a rising market. They reveal themselves clearly when the market stops rising. The Billy and Phil example in the original framework is genuinely instructive about one thing: time. Billy invests $200 a month starting at 20. Phil invests $300 starting at 30. Billy ends with 1.26 million. Phil with 678,000. The lesson about starting early is real and important. But the example assumes both Billy and Phil invested in the S&P 500 at 10% annually for their entire holding period. The math only works because the underlying instrument has verifiable historical earning power. If Billy had allocated his $200 monthly across crypto, a dropshipping business, and individual stocks he couldn't analyze, exactly as the formula's asset hierarchy permits, the numbers do not produce 1.26 million. They produce whatever the specific instruments produced. And without the knowledge to evaluate those instruments, Billy is not compounding. He is hoping. Compounding is the most powerful force in finance. I believe this completely. But compounding only works in one direction when the underlying investment has genuine earning power. In the wrong direction, in capital that erodes rather than grows, it is equally powerful and equally silent. Now let me tell James what I would actually do. The first thing I would do is ask the question the formula never asks. Do you understand what you own? Not the chart, not the ticker symbol. The actual business or asset. What does it produce? Why do people pay for it? What would have to change for that to stop being true? If you cannot answer those questions, you do not own something in any meaningful sense. You are holding it. The second thing, redirect your growth allocation toward what you can actually analyze. For most people in James's position, that means index funds as the primary vehicle. Genuine partial ownership of the entire productive capacity of the American economy at 10% annually over a century of documented history. You don't need to understand each company in the S&P 500 separately. You own the aggregate outcome of all of them. That is analyzable, verifiable, durable ownership. The third, build stability before you build growth. Not as a backup plan, as a prerequisite. James's stability fund is good. But it needs to be fully funded and untouched before a single dollar goes into any growth allocation. The emergency fund is what allows you to be patient with your investments rather than forced to liquidate them when the timing is wrong. The fourth, match your ambition to your knowledge. James put 40% of his growth bucket into crypto because the rule placed it on the spectrum. The correct question is not what percentage of growth should go to alternatives. It is whether you understand the alternative well enough to know what it is worth when nobody wants it. If the answer is no, the correct percentage is 0, not 10, not 5. 0. I have walked away from investments I didn't understand for 84 years. Some went up dramatically afterward. I have never regretted a single pass. Let me come back to James. In the first version of his future, he keeps following the formula. The percentages feel right. The structure feels disciplined. But 80% of his growth capital remains in instruments he cannot value independently. Crypto that follows market sentiment, a business model with no durable competitive position, individual stocks selected without a framework for analysis. In 10 years, his stability fund has performed exactly as promised. His growth allocation has roughly broken even across a decade of volatility. Not because he was unlucky, because the formula never equipped him to distinguish between ownership and speculation. In the second version, James pauses before the next allocation and asks the question the formula skipped. He redirects his growth bucket, index funds for the portion he cannot analyze actively. A small position in one or two businesses he genuinely understands. Companies whose products he uses, whose financial reports he can read, whose competitive advantages he can describe. Nothing in the alternative bucket, not because alternatives can never produce returns, but because he cannot answer what they are worth when no one else is buying them. In 10 years, James's second version has a portfolio that has compounded honestly, not as dramatically as the formula implied, but without the losses the formula enabled, and the income from real growing ownership is increasing every year. The top 1% do not follow percentage formulas. They understand what they own. The formula can tell you how much to invest. Only knowledge can tell you what to invest in, and only one of those two things determines whether the compounding works for you or against you. Subscribe to this channel and ring the bell. The next video goes through exactly how to evaluate whether something is genuinely worth owning. The questions I've asked for 84 years before putting a single dollar to work. That conversation is worth more than any formula. The discipline is not the mistake. The formula is not the mistake. The mistake is believing that a formula can replace the one thing that actually builds wealth. Understanding what you own. Everything else is confident-looking speculation. And now you know the difference. This content is produced with the assistance of artificial intelligence for educational purposes only. Nothing here constitutes personalized financial advice. Consult a qualified financial professional before making any investment decisions.